Have you ever wondered why some beginner investors consistently struggle to grow their wealth? Despite putting money into the stock market, the truth is, it's not market volatility that destroys your financial future. It's avoidable mistakes that quietly erode your capital over decades. In this video, we'll break down the top 5 investing mistakes that beginners make, explain why they are so harmful, and provide actionable strategies to safeguard your long-term wealth. By understanding these pitfalls, you can avoid panic selling, minimize unnecessary fees, and start building a portfolio that grows steadily and reliably over time. 1. Falling for the dividend yield trap. The first mistake many beginners make is chasing high dividend yields without understanding the underlying company. Stocks or funds promising 8% to 12% dividends may seem like free money, but often these high payouts indicate financial instability. Companies with unsustainable dividend policies may be distributing remaining cash instead of reinvesting in growth. As a result, the stock price can plummet faster than the dividend provides, leaving investors with net losses. For example, a company experiencing declining revenue may maintain high dividends to attract investors, masking financial weakness. Beginners who buy solely for yield risk losing capital while thinking they are generating income. To avoid this trap, research the company's financial health, payout ratios, and long-term growth prospects. Prioritize companies with stable earnings and a history of sustainable dividend increases. Remember, true wealth comes from a balance of income and capital appreciation, not chasing artificially high yields. 2. Investing via tax-blind account architecture. Many beginners default to standard taxable brokerage accounts because they're quick to open and provide instant access to funds. While convenient, this approach often overlooks one of the most critical factors in investing: tax efficiency. Over the long term, taxes can significantly reduce the compounding effect of your investments, quietly eroding wealth that could have been accumulated over decades. Capital gains taxes and dividend taxes are two main culprits. For example, earning $10,000 in capital gains in a taxable account might cost you $1,500 to $3,000 in taxes, depending on your tax bracket. The same $10,000 invested in tax-advantaged accounts like an IRA or 401k can grow uninterrupted, maximizing the compounding effect over time. The impact of taxes compounds dramatically over decades. Repeated annual taxes on dividends, interest, and capital gains can reduce a portfolio's value by hundreds of thousands of dollars over 30 years. For instance, a consistent investment of $5,000 annually in a taxable account versus a Roth IRA could result in a difference of tens of thousands or even hundreds of thousands of dollars by retirement due to the tax-free growth in the Roth. To maximize growth, investors should strategically leverage tax-advantaged accounts. Allocate retirement contributions to tax-deferred accounts like traditional IRAs or 401ks or Roth accounts depending on current versus future tax expectations. Consider fund placement based on tax characteristics: high-yield or bond funds in tax-deferred accounts and tax-efficient index funds in taxable accounts. Even seemingly small adjustments, like holding high dividend-paying investments in tax-deferred accounts, can dramatically improve long-term compounding and enhance the overall growth trajectory of your portfolio. By thoughtfully structuring your accounts with tax efficiency in mind, you preserve more of your investment gains, reduce unnecessary drag on returns, and harness the full power of compounding, creating a foundation for substantial long-term wealth accumulation. Planning for taxes is not optional. It's a strategic decision that distinguishes successful investors from those who leave money on the table. 3. Suffering from home country bias. Many new investors fall into the trap of concentrating all investments in familiar domestic companies. While it feels safe to invest in brands and markets you know, this approach exposes your portfolio to local economic downturns, regulatory changes, and currency fluctuations. Global diversification is essential. International markets often experience growth cycles that differ from your home country, providing opportunities to participate in trends that might be inaccessible domestically. For instance, emerging markets can offer higher growth potential due to rapidly expanding industries and populations, while developed foreign economies provide stability and additional sector exposure that complements domestic holdings. Failing to diversify geographically limits compounding potential and increases vulnerability to localized economic events, such as recessions, political instability, or currency depreciation. Investing solely at home can also restrict exposure to sectors underrepresented in your domestic market, like technology in emerging Asia or renewable energy in Europe. Avoid home country bias by investing in global index funds, international ETFs, or a mix of foreign equities. Diversification spreads risk, reduces volatility, and improves the likelihood of capturing long-term growth across multiple markets, creating a more resilient and balanced portfolio over time. 4. Overpaying for closet index mutual funds. Another major mistake beginners make is paying high fees for mutual funds or financial advisors, assuming they will outperform the market. Statistically, over 85% of active managers fail to beat low-cost index funds over a decade. Many funds quietly replicate benchmarks like the S&P 500 while charging 1% to 2% annual fees. Even a seemingly small 1.5% fee can reduce up to 1/3 of your portfolio's lifetime value due to the compounding effect. Over 30 years, that fee can translate to hundreds of thousands of dollars in lost growth, significantly impacting long-term financial goals. The solution is to prioritize low-cost index funds, or ETFs, which track market benchmarks without unnecessary management fees. Over time, reducing fees allows compounding to work more effectively, keeping more money invested and growing. Remember, minimizing costs is one of the most impactful strategies for building long-term wealth and achieving financial independence. 5. Executing panic rebalancing during market corrections. Many beginners panic when markets drop and try to time a bottom by selling assets and moving to cash. This is a classic wealth-destroying behavior. Market timing is nearly impossible. Selling during downturns locks in losses and often prevents you from benefiting from the fastest recovery days. Research shows that missing just the 10 best trading days in a decade can cut your long-term returns by half. Instead of reacting emotionally, focus on consistent, long-term investing. Rebalancing portfolios periodically is important, but it should be strategic, not impulsive. Keep a diversified asset allocation and maintain discipline during volatility. By avoiding panic-driven decisions, you allow compounding to continue uninterrupted, positioning your portfolio to recover and grow steadily over time. 6. Ignoring dollar-cost averaging. Beginners often wait for the perfect moment to invest, attempting to time the market. This delays wealth building and can result in missed opportunities. Dollar-cost averaging solves this by investing fixed amounts consistently, regardless of market conditions. This approach reduces emotional decision-making, spreads risk across market cycles, and ensures that you buy more shares when prices are low and fewer when prices are high. Over long periods, it smooths volatility and maximizes growth potential. By making investing a consistent habit, even small amounts contribute significantly to your portfolio's compounding. 7. Neglecting emergency funds before investing. Investing without an emergency fund exposes you to financial stress, which often leads to panic selling. Beginners frequently put all cash into markets without preparing for unexpected expenses like medical bills, car repairs, or sudden unemployment. A simple rule is to maintain 3 to 6 months of living expenses in a highly liquid account before heavy investing. This cushion ensures that market volatility does not force you to sell investments at a loss. Emergency funds also allow for opportunistic investing during market dips, giving you flexibility to act strategically rather than react emotionally. 8. Overlooking continuous education and research. Finally, beginners often neglect the importance of financial literacy. Understanding the mechanics of investing, fees, tax implications, and portfolio construction is critical. Relying solely on tips or trends can lead to poor decisions. Invest time in learning about market fundamentals, investment strategies, and personal risk tolerance. Use calculators, such as the NerdWallet Compound Interest Calculator, to visualize growth and understand long-term implications of decisions. Continual education empowers informed decisions, reduces mistakes, and increases confidence in your portfolio's long-term success. By avoiding these 5 major beginner investing mistakes, chasing high dividends blindly, using tax-inefficient accounts, limiting diversification, overpaying for funds, and reacting emotionally to market changes, You protect your capital and maximize the benefits of compounding. Combine this with consistent investing, proper emergency funds, and ongoing financial education, and you create a resilient portfolio designed to build generational wealth. So, there you have it. 5 beginner investing mistakes that can quietly destroy long-term wealth and the strategies to avoid them. By understanding these pitfalls and implementing disciplined, informed investing habits, you can protect your portfolio and set yourself up for decades of financial growth. If you found this video helpful, don't forget to like, share, and subscribe for more actionable investing insights and wealth-building strategies. Thanks for watching, and we'll see you in the next video.